welcome. You're watching the Money Control Show. I'm Sakshi Batra and this is where we talk about macros, markets and money. On the show today, we will discuss about the budget announcements with respect to CPSE ETF, which the government plans to introduce in a tax-saving mutual fund scheme format. We'll also discuss about government's quest to become a $5 trillion economy. And we'll get you insights into the stock markets and the cues you need to watch out for in the coming week. Well, the dust has almost settled down after the last week's union budget. Although taxpayers didn't get to cheer any announcements with regards to tax exemptions. But Finance Minister Nirmala Sitharaman did announce that going forward, CPSE ETF would be available in equity-linked savings scheme formats and also suggesting there would be more such ETFs hitting the market. Kayezad Adajania, Moneycontrol's personal finance editor, joins in to share with us how will this really benefit the investors. Welcome to the show, Kayezad. Thank you for joining in. Now, first up, for the benefit of all our viewers, could you explain to us what is ELSS and also why is the new format being introduced for CPSE ETF?
Hi, Sakshi. Now, to begin with, CPSE ETF stands for Central Public Sector Enterprises Exchange Traded Fund. So basically, it's nothing but an exchange traded fund meant for the government to disinvest its stake in several public sector units at the same time. Now, CPSE and Bharat 22 ETFs are the two such vehicles that the government has used to disinvest its stake in various state-owned enterprises. As the name suggests, this is an exchange traded fund. It's an ETF, which means that it is like a mutual fund scheme, but it is a passively managed mutual fund scheme, and it is you can buy and sell these ETFs only on the stock exchange. Okay, you need a demat account for that. Now, these are passively managed funds, which means that there is no fund manager risk. So, at any given point in time, your money would be invested in all the scrips in exactly the same proportion as they lie in the benchmark indices of these two funds. Now, so far, these CPSE funds, that is these ETFs, have come in an open-ended structure, which means that you can buy today, sell tomorrow, and it's easier for you to get it and get out at any point in time. But now the budget announcement, as you rightly pointed out, said that the CPSE ETF would be available in an ELSS format. So what is an ELSS format? An ELSS is actually a tax-saving mutual fund scheme. It's an equity scheme that's prevalent in the markets today, and it's offered by all mutual fund schemes. So it's just another type of an equity mutual fund scheme that gives you a Section 80C tax reduction benefit of up to an investment of 1.5 lakh rupees. So if you invest in this fund, you get a Section 80C tax reduction benefit. Your money will be locked in for 3 years. So now what the Finance Minister Nirmala Sitharaman said that, in future, the government would also come out with these CPSE type of vehicles in an ETF format, which has been the case, but also additionally in an ELSS format.
Right, so there is another avenue where investors can park their money for getting the Section 80C benefit. But will my investments in CPSE ETF be locked in?
Yes, it will be locked in because you see it's an ELSS format, so which means that since it offers Section 80C tax reduction benefits, there will be a certain lock-in. Now, so normally if you see ELSS schemes come with a 3-year lock-in. So obviously you can safely assume that even the CPSE ELSS, as and when it comes out, will have a 3-year lock-in, because obviously you're getting an upfront Section 80C benefit, you're getting a tax reduction benefit. So the price that you have to pay is that you have to lock in your money for a certain amount of time. So yes, it would come with a lock-in.
Right, Kayezad. Now, we do know that CPSE ETF has so far been used by the government to divest stake in PSU companies. Could you elaborate on the significance of these CPSE ETFs?
Okay, so just getting down to the basics of what exactly is CPSE and what exactly is Bharat 22, both these vehicles are ways of that the government of India has adopted to disinvest its stake in several public sector enterprises. Now, what it means is, over the years, we've known that the government has held its position in several companies, let's say in oil and gas, in power distribution companies, in petroleum companies, even in banks also, where the government has held massive stakes for a number of years and even decades. But after India's liberalization, there's been this thought in the government and even elsewhere that the government is not in the business of managing companies. The government is in the business of running the country, managing the country, right? So eventually the government has to get out of the management of these companies, which is when which is why, the government has over the years been disinvesting its stake in all these companies. Now, traditionally, Sakshi, what's been the method of disinvestment? The government will pick up, let's say, 2, 3, 4, 5 companies at different points in time, and they will say, okay, we'll disinvest the stake in this company today. Tomorrow, we'll disinvest our stake in this company. Day after tomorrow, we'll select another company and all that. So it used to happen in a very piecemeal basis. But what happened is that they, a few years back, they did a deep research on this, and they realized that there is in fact a better way to disinvest its stake in several of these companies. So they looked towards Hong Kong. For example, in 1999, when Hong Kong administration decided to disinvest its own stake in several companies in the Hang Seng Index, they adopted an ETF route. So they created a basket of all these companies at one time, and they offloaded that stake in an ETF, and then this ETF was distributed or rather available for sale for all the retail and institutional investors. So it actually gets them a very good price, and it's a very efficient way of disinvesting the government stake. So that's how this ETF was born, and the government then decided to disinvest its stake in first a set of 10 companies through CPSE ETF, and later on in a set of another 22 companies through Bharat 22 ETF.
Right, so which CPSE ETFs are available in the market right now?
So there are two such ETFs available. One is the CPSE ETF, as we discussed. It was launched in 2014, March 2014 to be precise, and then later on in November 2017, Bharat 22 ETF was also launched with another set of 22 companies. Now, CPSE ETF, Sakshi, is managed by Reliance Mutual Fund, Reliance Nippon Asset Management Mutual Company, and Bharat 22 is managed by ICICI Prudential Asset Management.
And in terms of returns, how have these ETFs performed, and should investors consider investing in these ETFs?
So, it's been a mixed bag so far. We've not had a very detailed or rather a very long-term performance track record of both these funds, because they were launched in the recent 4 or 5 years. CPSE ETF has been, has had a very sort of, I would say, a low to moderate performance. Bharat 22 ETF has done slightly better but mainly because of 2 or 3 companies that are there in the index, in the Bharat 22 index, which has done well. Now, usually CPSE ETF and Bharat 22 ETF are meant for both retail as well as institutional investors, but mostly institutional investors have taken advantage of the discount that these ETFs offer at the time of IPO, and then they sell these units once they are listed. So basically, it's an arbitrage opportunity for large investors, and retail investors have mostly stayed away from these ETFs. Now, if you ask us personally, we don't think that these ETFs are really such pressing investments at the moment, unless and until you are willing to hold on to them for a really long amount of time, because they are public sector enterprises. So they are dependent on a lot of government policies. They are still government-owned companies, right? So a lot of their fortunes are dependent on the government policies, what the government wants to do with them, how soon the government want to disinvest, and all these factors. So yeah, I mean, these options are there. They are very efficient options to participate in the government's disinvestment measure, but you should invest in them only if your core portfolio is well settled, and you want to top it up with some exposure in these disinvestment opportunities. And also, as I said, hold on to them for a really long amount of time. Otherwise, there's no really pressing need.
Well, thanks, Kayezad, for sharing all this valuable information around CPSE ETFs with us. Moving on, India has set the target of $5 trillion economy to be achieved by 2024. Where do we stand with respect to that right now, and what will it take for us to reach that goal? Watch this insight to find out. The government has set a target of turning India into a $5 trillion economy by 2024. In 2017, India had become the 6th largest economy in the world in terms of GDP. Gross domestic product is the total value of goods and services produced in the country. India's GDP was about $1.85 trillion in 2014. It now stands at about $2.7 trillion in 2018. According to IMF projections, India's GDP should reach $4.7 trillion in 2024. India is likely to overtake United Kingdom as the fifth largest economy by the end of this year. India's GDP, according to the IMF, will likely touch $2.97 trillion compared to the United Kingdom's $2.82 trillion. If India's GDP crosses $5 trillion, it would become the fourth largest economy, overtaking Germany, whose GDP, according to IMF projections, will be at $4.9 trillion in 2024. In purchasing power parity terms, India is already the world's third largest economy with a GDP of $10.39 trillion, behind China's $25.26 trillion and the USA's $20.73 trillion. The average Indian, however, earns far less than compared to many other countries. India's annual per capita income stood at $2,036 in 2018, compared to $9,608 in China and $62,605 in the USA. In the next 5 years, according to the IMF, India's per capita is set to rise to $3,277 in 2024, compared to $15,102 in China and $75,456 in the USA. According to the latest economic survey, to achieve the objective of becoming a $5 trillion economy by 2024, India needs to sustain a real GDP growth rate of 8%. Investments, especially private investments, is the key driver that drives demand, creates capacity, increases labor productivity, introduces new technology, allows creative destruction, and generates jobs. To discuss about India's quest to become a $5 trillion economy by 2024 and to discuss the challenges and possibilities of achieving this target, I am joined by Gaurav Choudhury. Thanks a lot, Gaurav, for joining in. Now, the Finance Minister, the Prime Minister, Niti Aayog, everybody have been very confidently vocal about achieving this target by 2024. But some of the experts are also doubting this and also calling it a piped dream. How realistic is this target really, according to you?
Well, if you go by past trends and if you go by, say, in the year that India hit $1 trillion Indian GDP, that was 2007, and that was considered to be a big achievement those days, because as it was a big achievement. In 2014, we were a $1.8 trillion economy. Our GDP was about between 1.7 and 1.8.
Yeah.
We are now about $2.7 trillion. To become a $5 trillion economy in the next 5 years, we have to probably grow at our GDP at a nominal rate that is not adjusted for inflation. We'll have to grow at about 12% on an annualized basis.
Okay.
If you go by past trends, that doesn't seem unachievable. Okay. Only a few things need to fall in place. Right. But those are critical things. Say for say for instance, investment has to grow at a certain pace. Likewise, savings and consumption, etc., etc. But having set the target of 5 trillion, even if you fall a little short, we would have achieved something. Right. And the whole momentum of making India a $5 trillion economy can actually generate a lot of positive spin-offs.
Absolutely. But in the economic survey also, Finance Minister Nirmala Sitharaman also highlighted that to achieve this target, we actually need to grow at a real GDP rate of 8%. Now, considering the global weak environment that we are seeing, we are in the middle of a slowdown as well. Is it possible to achieve this 8% growth target when most of the brokerage houses, IMF, World Bank, they have all cut down our growth estimates as well?
Yeah, so a lot will depend on how our domestic economy actually moves. I mean, the exports is one part of it, and that is merchandise exports. So if the world economy is wobbly and it's on a shaky ground, then exports will clearly get affected. That is only one part of it. But we need to keep in mind that a large part of the Indian economy, India's GDP, the edifice is the private consumption story. And if we are able to push private consumption at a certain pace, and if the rapidity of that growth consistently maintains a certain pace, then moving towards a $5 trillion GDP mark may not be unachievable.
Right.
It could look very, very achievable, but a lot will depend on how consumption picks, private consumption picks pace. And for that, it is, as you now see, that at this point in time, private consumption is slowing down,
yes,
and that can
yes.
be seen from various proxy indicators like car sales, etc.
Sure.
So the first task is to ensure that private consumption picks up, but that alongside, the government will also have to ensure that investment picks up at a certain pace, because the investment has also a very strong consumption multiplier. In high investment both by the government, and which will also crowd in private investment and actually can end up stoking consumption, which is going to be good.
Absolutely. You talked about investment and as well as consumption. I'll talk about that a little later as well. But first of all, last week we also saw the union budget being presented. Is there a roadmap to really achieve this $5 trillion economy target that has been laid in the budget?
So I don't think the budget itself alone has laid down the roadmap, but the budget did say that 5 trillion, turning India into a $5 trillion economy, where the GDP in nominal basis touches $5 trillion by 2024. Is a stated goal of this government. And if you go by IMF projections, for instance, which they have put out recently, India should touch about 4.7 trillion by 2024, according to their projections. So it's not very far away from the 5 trillion mark that the government has set. But again, as I said, even IMF projections will come true only based on a certain set of assumptions. One big assumption there is, as the government is fully aware of it, is also investment. And that is why the whole focus is on making investment, not just government investment, also private investment. Right. And say, for instance, investment in physical infrastructure projects like railways, roads, highways, ports, airports, etc. And that is why when the government is talking about 100 lakh crore, 100 trillion rupees of investment in India over the next 5 years in infrastructure, that's going to be a very, very big critical component to find out whether actually India reaches the $5 trillion mark or not. So, and it is just not government investment. So if a road is being built, it is not just government that is pumping in money. Government will, at times of depressed private investment, government can come in and raise its level of investment, so that will crowd in private investment, which is something that the government is seeking to do. But investment in physical infrastructure is absolutely critical for India to reach the $5 trillion GDP mark.
Absolutely, rightly said and pointed out as well. Now, we've also seen Vice Chairman of Niti Aayog, Rajiv Kumar, also point out that this target cannot be achieved by government alone. Yes. We do need private investments. Yes. And Union budget also stressed upon the fact that, investments should be kick-started. What are the structural steps that the government has really announced that will encourage private investments now?
So private investment will have to continue very rapidly in infrastructure, and for that, an enabling environment has to come about. One of the big things that the government has done shortly after taking over is to announce its intent to bring about labor reforms, and we have seen that the cabinet has, just before the budget, the cabinet has actually announced that the government is going to bring out a new labor code. There will be resistance from labor unions, etc. But labor reforms, multiplicity of labor laws, very rigid labor markets makes India a difficult place to do business in. So if investment has to come in, labor laws will have to be reformed. That is what a one dominant strand of thought says. So it acts, while otherwise India should act as should have been a very large market. Investment is not coming to proportionate to the size and the scale of the market. One of the reasons being cited is the rigid labor market, and if you dismantle those rigidities, make it more easy for investment to come in, businesses to do business in, then sure, investment will definitely flow in. That is what the assumption is. So clearly government is trying to create an enabling policy environment through which investment comes in, and along with it, once the investment takes place, obviously with a bit of a time lag, along with it will come the other attendant spin-offs, say for instance jobs. But 100 lakh crore investment, private and public investment put together in infrastructure, is absolutely critical.
Absolutely, and you rightly pointed out about the investments part, but now about consumption, which you were talking about earlier as well. We are facing a slowdown in consumption, and there's a dire need that we all focus on it and revive the consumer sentiment right now. Much as you said that the government is focusing on making investments easier, encouraging private investments, but very less was said in the union budget about reviving the consumption sentiment.
So that is one criticism of this budget, which many critics have pointed out, and there was a lot of expectations riding on this budget to stoke consumption. Consumption, as we know, is in the middle of a we are in the middle of a private consumption slowdown, and that can be seen from the repeated car sales growth numbers that have been coming over the last 3-4 months, and in every successive months, it's a testimony to the fact that people are buying fewer cars. So if people are buying fewer cars, then the consumption is slowing down. One would have expected the budget to come out with some measures, probably in the form of tax breaks to individuals to give more money in their hands to spend, but that did not come out. So the budget has fallen short of expectation. It's a bit of a disappointment for the salaried and the middle class, who actually lead the way in consumption of goods, and they have been the flag bearers of India's consumption boom. But the budget did not have much for them. Although if you ask the government, they said that only recently in the interim budget was the tax slab change, at least for those earning less than 5 lakh rupees or those who are in the lower band of the income scale. But yes, unless consumption, people have more money in their hands to spend, then consumption will remain sluggish, and that could affect the pace at which we probably are going to reach the $5 trillion GDP mark.
Thanks a lot, Gaurav, for sharing all that insight with us. Well, there are plenty of challenges that face the government and the economy, the right policy measures to kickstart investments. We also need to revive the consumer sentiment, combat a global slowdown, and also address unemployment. There are enough and more hurdles that we need to cross. And will we be able to achieve this mammoth target? That only time will tell us. Moving on to markets now, Kshitij Anand, editor of markets at Moneycontrol, joins in with all the action in the stock markets and cues for the week ahead. Thanks a lot, Kshitij, for joining in. Now, a week has passed after the union budget. Markets have not been excited and have been struggling to find support near crucial levels. How did the action pan out on the street?
Well, it's actually a week after the budget, and it wasn't the way how, sort of bulls would have planned out to be. But then again, Nifty 50 sort of moved in a narrow range of about 200 odd points, where 11,460 was at the lower end of the range and 11,600 was at the higher end. Now, remember, this comes at a time when US markets have hit fresh record highs, and we are actually barely keeping above 100 days exponential moving average. But then again, positive cues, positive commentary from US Fed actually helped Nifty climb above this 100 days exponential moving average. So that's a positive sign for the bulls. Now, what really led to the fall on Indian markets, or what really dampened the sentiments? I think budget proposal of a higher tax surcharge on super rich would in fact hurt FI investments as well as HNIs. That really weighed on the street. In fact, if you look at the data for this week as well as for the month of July in totality, foreign institutional investors have been net sellers in Indian market, and the selling got extended this week only. If you look at for the whole of July, FI was net sellers in Indian equity markets, especially in the cash segment, for more than 2,000 odd crores. For the coming week, in terms of technicals, I think 11,460 will be an important support to watch out for, and at the higher end of the range, I think 11,600, 11,700 will be an important bit of resistance to watch out for.
Well, Kshitij, the focus has come back to earnings now. We have seen TCS kickstart Q1 results as well. What are these early numbers indicating about the entire earnings season?
Well, it's actually, the June quarter earnings are likely to be a repeat telecast, you could say that, of the March quarter. And in one word, if I have to sum it up, I'll say uninspiring. Now, TCS came out with the results, and in fact, TCS, which is the bellwether of Indian IT industry and the second largest company in terms of market capitalization just after Reliance Industries, actually surprised the street with slower growth as well as softer margins. Now, most global brokerage firms which have reacted on the TCS results actually maintain their rating, but then again reduce their target price marginally. Credit Suisse, which maintains a neutral rating on TCS, actually reduced the target price to 2,000 from 2,130 earlier. CLSA also reduced the target price to 2,570. Now, come Monday morning, street will react to Infosys results, but all in all, I think I would say that there's a high probability that June quarter earnings will more likely be a mixed bag.
All right, Kshitij, then what are the big cues and earnings to watch out for in the coming week?
Well, Sakshi, yes, the coming week will be dominated by macro triggers as well as earnings. Now, in terms of macro triggers, investors will watch out for WPI data, which will be out on Monday. And on the earnings front, more than 70 companies on the BSE will declare their results for the quarter ended June. Now, let's look at the prominent names. On the 17th of July, IT stocks will be in focus because Mindtree and Wipro will be declaring their numbers. Apart from that, on the banking space, Yes Bank will be in focus. That will be out on the 17th. On the 18th of July, we have ACC, Colgate Palmolive, as well as L&T Infotech. On the 19th of July, we have Dabur India as well as Reliance Industries. And on the 20th, we have HDFC Bank. So all in all, I think investors should keep a watch on the lower end of the range, that is 11,460, which will be an important support for the Nifty index.
Thanks a lot, Kshitij, for sharing with us all those details. And with that, it's also a wrap here on the Money Control Show. But you can catch up on all the news from the world of business and finance on our digital platform, moneycontrol.com. Many thanks for tuning in.